We have officially entered the realm of the impossible. For the last 48 hours, we have been analyzing the symptoms of the market. We looked at the crash to $86. We looked at the closed doors of the United States Mint. We looked at the $13 premium in Shanghai. These were all clues. They were the smoke signals telling us that a fire was burning somewhere deep inside the financial system. But today, Saturday, January 17th, 2026, rumors are circulating that suggest the fire is much larger than anyone imagined. We are looking at a highly controversial, unverified ledger that has gone viral across institutional trading desks this morning. This document purports to show the shadow short positions of the largest banks in the world, positions that are hidden in the over-the-counter derivatives market and do not appear on the official government reports. And the numbers on this page are not just bad, they are terminal. According to these leaked estimates, two of the largest banks in the United States, Bank of America and Citigroup, could be sitting on a combined net liability of up to 4.4 billion ounces of silver. Let me repeat that number because it is so large, it sounds almost fictional. 4.4 billion ounces. Now, we must be careful. The official commitment of traders report shows a short position of around 500 million ounces. That is already massive. But if this leak is true, if the banks have hidden another 4 billion ounces in off-balance sheet derivatives, then the math of the silver market is fundamentally broken. To understand why this would be a death sentence for these institutions, you have to understand the physical reality of the silver market. The entire global mining industry, every mine in Mexico, Peru, China, Russia, and Australia combined, produces approximately 800 million ounces of silver per year. That is the hard ceiling. We cannot print more. We cannot dig it up faster. So, do the math. If global production is 800 million ounces, and these banks have allegedly sold 4.4 billion ounces, they have effectively sold 5.5 years of total global supply. They have sold silver that has not been mined yet. They have sold silver that will not be dug out of the ground until the year 2031. This is the textbook definition of a naked short. They have sold a promise that they cannot physically keep. In a normal market, a short seller borrows an asset, sells it, and hopes to buy it back cheaper. But to do that, the asset has to exist. You have to be able to find it. Where are Bank of America and Citigroup going to find 4 billion ounces of silver? They cannot find it at the COMEX. The registered inventory is down to 120 million ounces. They cannot find it at the US Mint. The Mint has suspended sales. They cannot find it in London. The vaults are empty. Whether the number is 500 million or 4 billion, they are trapped in a mathematical prison of their own making. This explains the violence we saw on Thursday. Remember the flash crash? Remember how the price dropped from $92 to $86 in minutes? The media told you that was profit-taking. The media told you it was a technical correction. They were likely lying. That crash looks exactly like a desperate survival-level attempt to manage a liability that is spiraling out of control. Every time the price of silver goes up by $1, a short position of 4 billion ounces loses $4 billion. When silver went from $50 to $90, if these rumors are true, they lost roughly $160 billion in paper value. This is why they smashed the price. They were not trying to make money. They were trying to stop the bleeding. They were trying to prevent a margin call that would liquidate the bank. But here's the problem with a naked short of this magnitude. It creates a black hole in the market. Because they have sold 5 times more silver than exists in the annual supply, they have created a future demand that is 5 times larger than the future supply. Eventually, they have to close these positions. They have to buy back the contracts. Who are they going to buy them from? Are they going to buy them from you? Are they going to buy them from Samsung? Are they going to buy them from the Chinese government? Nobody is selling. This is why the price bounced back so quickly. The market realizes that the short interest, whether official or shadow, is actually just future buying pressure. Every short position is a guaranteed future buyer. Bank of America is not a seller of silver. They are a guaranteed buyer of silver. They just haven't bought it yet. This realization flips the entire narrative on its head. We are not looking at a market that is overbought. We are looking at a market that is oversold to a degree that has never happened in the history of finance. If the shadow leverage is real, we are looking at a short interest relative to annual production of 550%. Compare this to the Volkswagen squeeze of 2008. In that squeeze, the short interest was roughly 12% of the float, and the price went up 500% in a day. Compare it to the GameStop squeeze. The short interest was 140%, and the price went up 1,000%. We are looking at a potential short interest that dwarfs anything we have ever seen. The potential energy stored in this trade is nuclear. And this brings us to the counterparty risk. If you hold a paper contract for silver on the COMEX, who is on the other side of that trade? Who promised to deliver that silver to you? It is likely one of these massive banks. If they owe billions of ounces and they only have access to maybe 50 million ounces in their vaults, they are insolvent. They cannot deliver. This means that the millions of people holding paper silver are holding a contract with a bankrupt entity. They are holding a promise from someone who cannot pay. This is why the physical price is decoupling. The physical market suspects that the paper market is a fraud. When dealers charge $120 for a coin, they are pricing in the risk that the banks will fail. They are pricing in the reality that the paper contracts are worthless because the metal doesn't exist. We have spent years talking about manipulation. We talked about spoofing. We talked about capping. But this leaked data changes the conversation. This isn't just manipulation. This is recklessness on a scale that threatens the stability of the entire global financial system. These banks have supposedly bet the house against silver, and silver is winning. In the next part of this deep dive, we are going to calculate the insolvency number. We are going to take the current price of $90, multiply it by this rumored short position, and show you the hole in their balance sheet. We are going to compare that number to the total equity of these banks, and we are going to show you why the Federal Reserve will have no choice but to intervene. But they won't intervene by finding more silver. They will intervene by printing more dollars. The math is terminal. The liability is absolute, and the clock is ticking. We have established the premise, based on the leaked data circulating on institutional desks, that Bank of America and Citigroup may be holding a combined shadow short position of 4.4 billion ounces of silver. Now, we must do the math that the mainstream media is too afraid to do. We must calculate the mark-to-market damage. We must quantify the hole in the hull of the ship. Take the current price of silver, let's call it $90 an ounce to keep the math simple. Multiply $90 by 4.4 billion ounces. The result is $396 billion. Let that number sink in, $396 billion. This is not a trading loss. This is not a bad quarter. This is a solvency event. To put this number into perspective, let's look at the market capitalization of these banks. The market cap is the total value of every single share of stock the bank has issued. It is what the market thinks the entire company is worth. Citigroup has a market cap of roughly $120 billion. Bank of America has a market cap of roughly $260 billion. If you add them together, their combined equity value is roughly $380 billion. The liability from the silver short position, $396 billion, is larger than the total value of the banks themselves. If they were forced to cover this position at $90 today, they would be wiped out. Their equity would be zero. Their shareholders would be zeroed out. The banks would technically be bankrupt. And that assumes they could cover at $90. But, as we discussed in part 1, if they tried to buy 4 billion ounces, the price wouldn't stay at $90. It would go to $500. So the liability isn't $390 billion. It is theoretically infinite. This insolvency equation is the key to understanding the insane volatility we witnessed on Thursday. When silver hit $92, the algorithm at the risk desk started flashing red. The liability was crossing the threshold of the bank's Tier 1 capital reserves. They were facing an immediate margin call from the clearinghouse. They had two choices. Choice A, admit defeat, buy back the shorts, send the price to the moon and declare bankruptcy. Choice B, sell everything they had, paper contracts, gold, equities, to smash the price of silver back down to $86. They chose choice B. By smashing the price from $92 to $86, they reduced the price by $6 per ounce. $6 times 4.4 billion ounces is $26.4 billion. In a matter of minutes, they reduced their paper liability by $26 billion. That is enough to satisfy the margin clerk for one more day. That is enough to keep the lights on for one more night. This wasn't trading. This was survival mode. They were not trying to profit. They were trying to avoid immediate liquidation. But here's the catch. This strategy only works if the price stays down. But the price didn't stay down. It ripped right back to $90. The $26 billion of relief evaporated as fast as it appeared. They are right back where they started, but with one major difference. They have used up their ammunition. They have exhausted their ability to shock the market. And while they are fighting the paper war on the screen, the physical market is sending a signal that confirms they are already dead. That signal is backwardation. In a normal market for a non-perishable commodity like silver, the future price should be higher than the spot price. This is called contango. It costs money to store silver, to insure it, to secure it. So silver for delivery in 6 months should cost more than silver for delivery today. But right now, the market is in backwardation. The spot price is higher than the futures price. And critically, the lease rates are skyrocketing. A lease rate is the cost to borrow physical silver. If you are a bank and you're short, you can try to lease silver from someone else to deliver it and kick the can down the road. When lease rates go vertical, as they are doing right now, it means there is no silver available to borrow. The owners of the silver are saying, "No, I won't lend it to you. I want it in my vault." This is the physical market screaming that there is a shortage. When you combine a 4 billion ounce paper short with a physical market and backwardation, you get a death spiral. The banks need to borrow silver to cover their shorts, but they can't borrow it because lease rates are too high. So they have to buy it. But they can't buy it because the price is too high, and they are insolvent. So they try to smash the price. But the smash fails because the physical buyers step in. It is a trap with no exit. This brings us to the systemic risk implied by this leak. If Bank of America and Citigroup are insolvent because of silver, this is not just a silver problem. It is a global financial problem. These banks are global systemically important banks, GSIBs. They are the plumbing of the world economy. If they fail, the derivatives market freezes, the credit market freezes, ATMs stop working. This is why the Federal Reserve and the U.S. Treasury are involved. They know about this short position. They have seen the ledger. Why do you think Treasury Secretary Bessent called an emergency G7 meeting? Why do you think the U.S. Mint suspended sales? They are trying to manage the collapse of this short position without destroying the dollar. They are trying to engineer a soft landing for a 4 billion ounce bomb. But there is no soft landing for a naked short in a commodity shortage. There is only a hard landing. The only way to save the banks is to bail them out. The Federal Reserve will have to print $390 billion, and likely much more, to cover these losses. They will have to monetize the silver short. This means that the price of silver isn't just going up because of supply and demand. It is going up because it is being repriced in a currency that is about to be diluted to save the banking system. We are watching the setup for the greatest transfer of wealth in human history. The wealth is transferring from the banks who sold paper silver to the individuals who bought physical silver. The insolvency equation has been solved. The result is zero for the banks and infinity for the metal. But history tells us that this kind of event doesn't happen in a vacuum. It happens in cycles. It happens according to a rhythm that has repeated for over 100 years. There is a chart, a pattern, that predicted this exact moment. It predicted that the year 2026 would be the year of the commodity boom and the stock market bust. In the next part of this deep dive, we're going to look at the BENNER cycle. We are going to show you a chart drawn over 100 years ago that pointed to this specific year as the turning point. We are going to explain why the trap the banks have fallen into was predictable, cyclical, and inevitable. The banks are fighting math. They are fighting physics, and now they are fighting history. The $390 billion bill has come due, and they cannot pay. We have analyzed the impossible math of the 4.4 billion ounce short position. We have dissected the insolvency equation that threatens to wipe out the equity of the world's largest banks. But to truly understand why this is happening right now, why the system is breaking in January of 2026 and not a year earlier or a year later, we have to look beyond the balance sheets. We have to look at the rhythm of history itself. There is a chart that has been circulating quietly among the most elite macro investors for decades. It is not a chart produced by a Goldman Sachs algorithm. It is not a chart generated by an artificial intelligence. It is a hand-drawn chart from the year 1875. It was created by a prosperous Ohio farmer named Samuel Benner. Benner noticed that market panics, commodity booms, and financial crashes followed a specific, repeatable pattern. He mapped this pattern out on a piece of paper over 150 years ago. He called it the BENNER cycle. For a century and a half, this chart has predicted almost every major financial turning point with terrifying accuracy. It predicted the panic of 1929. It predicted the bottom of 1932. It predicted the dot-com bubble of 2000. It predicted the crash of 2008. And now we are looking at the chart again. And there's a red circle around the year 2026. According to the BENNER cycle, 2026 is designated as a year of good times, high prices, and the time to sell stocks and values of all kinds. Now, you might hear good times and think that sounds positive for the banks, but you have to understand what Benner meant. In his cycle, high prices marks the blow off top. It marks the peak of the mania. It marks the moment of maximum danger where the smart money exits the paper market before the crash. It says explicitly, time to sell stocks. This is the prophecy that the banks ignored. Bank of America and Citigroup built their massive short positions in silver based on the assumption that the paper age would last forever. They assumed that they could suppress commodity prices indefinitely while the stock market and the bond market climbed to the moon. They bet against the cycle. The Benner cycle dictates that capital rotates. It moves from paper assets, like stocks and bonds, into hard assets, like commodities and land. This rotation happens at the peak of the cycle, when confidence in the paper system is highest, just before it collapses. We are living through that exact pivot point right now. The short squeeze in silver is not an isolated event. It is the mechanism by which the BENNER cycle enforces its will. Think about it. The banks are short silver. That means they are betting that the price of hard assets will go down. But the cycle says that we are entering a period where paper assets crash and hard assets explode. They are standing on the beach, trying to hold back the tide of history with a paper contract. This explains why they are trapped. They didn't just make a bad trade, they made a fundamental error in judging the economic season. They are trying to harvest crops in the middle of winter. When the BENNER cycle turns, the flows of capital become irresistible. We are talking about hundreds of trillions of dollars in global wealth looking for a new home. If the cycle says sell stocks, where does that money go? It cannot go into bonds because inflation destroys bonds. It cannot go into cash because the dollar is losing value. It has to go into commodities. It has to go into the Industrial Revolution materials we discussed: silver, copper, lithium. This creates the commodity supercycle. The banks are short the supercycle. They are short the very thing that the entire world is trying to buy. And this brings us back to the trap. Why did the banks build such a massive naked short position? Were they stupid? No, they were arrogant. They believed that they were the market. They believed that because they could print unlimited paper contracts, they could override the laws of supply and demand. They believed they could override the cycles of history. This is the hubris that always precedes the fall. In 2008, the banks believed that housing prices could never fall nationwide. They built a derivative empire on that false assumption. And when the cycle turned, they were wiped out. In 2026, they believed that silver could never break $100. They built a 4 billion ounce short position on that assumption. And now that the cycle has turned, they are being wiped out again. But this time, the bailout will be harder. In 2008, they just had to print money to fill the hole. This time, they need physical metal to fill the hole, and you cannot print silver. The BENNER cycle chart is a warning from the past. It tells us that these moments of high prices and selling stocks are followed by years of hard times. Hard times for who? Hard times for the holders of paper. Hard times for the people who trusted the banks. Hard times for the people who stayed in the stock market too long. But for the people who hold the real assets, the silver, the gold, the land, these are not hard times. These are the times of wealth transfer. The banks are fighting to keep the good times of the paper market going for just one more month, one more week, one more day. That is why they smashed the price to $86. They are trying to delay the inevitable turning of the calendar, but time only moves in one direction. The year is 2026. The cycle has arrived. The great rotation from paper to metal is happening. The leaked ledger we discussed in part 1 shows us the magnitude of their bet. The BENNER cycle shows us the futility of their bet. They have bet 4.4 billion ounces of silver that history is wrong. I wouldn't take that bet. This historical context is crucial because it tells you that the volatility we are seeing, the violent swings, the desperate smashes, is not chaos. It is the sound of a paradigm shift. It is the sound of the tectonic plates of the financial world grinding against each other as the pressure builds. The banks are on the wrong plate. They are on the plate that is sinking. You, the silver holder, are on the rising plate. And this brings us to the end game of this specific crisis. If the banks are insolvent, if the cycle has turned, and if the physical metal is gone, what is the next logical step? How does a bank exit a trade when it owes metal it cannot buy and cannot borrow? There is only one way out. It is a legal clause hidden deep in the fine print of the futures contracts. It is a clause that most investors have never read and never thought would be used. It is called force majeure, or in plain English, cash settlement. In the final part of this deep dive, we are going to explore the force majeure scenario. We are going to explain exactly what happens when Bank of America and Citigroup declare that they cannot deliver the silver. We are going to look at the wholesale freeze that is already starting. Dealers are quoting 6-week delays. Refiners are allocating production. The system is preparing to default. And when they default, the price on the screen, whether it is $90 or $100, becomes meaningless. The price becomes infinity because you cannot buy it. The BENNER cycle predicted the turning point. The leaked ledger revealed the victim, and the force majeure will deliver the final blow. We are witnessing the death of the paper derivative market in real time. Welcome to the commodities supercycle. We have arrived at the conclusion. If you have been with me through this entire forensic investigation, you now understand the terrifying scope of the trap the banks have built for themselves. You understand the impossible math of the 4.4 billion ounce short position. You understand the insolvency equation that threatens to wipe out the equity of the Western banking system. And you understand the BENNER prophecy that predicted this exact moment in history over 150 years ago. The evidence is overwhelming. It is not a theory. It is a mathematical inevitability. We are not looking at a trading correction. We are not looking at a normal market cycle. We are looking at the end of the paper derivative market as we know it. So, how does this end? How do the banks escape a $390 billion liability when they do not have the metal to cover it? They do not buy the metal. They do not deliver the metal. They declare force majeure. This is the legal term that has been whispered in the back rooms of the commodities market for weeks. It is a French term that translates to superior force. In contract law, it is the escape hatch. It allows a party to break a contract without penalty if they are prevented from fulfilling it by an event beyond their control. Usually, force majeure is reserved for acts of God, hurricanes, earthquakes, wars. But in the coming days or weeks, we believe the bullion banks will attempt to use it to describe the unprecedented market conditions that they created. They will claim that the Shanghai squeeze, the retail hoarding, and the supply chain disruptions have made it physically impossible to deliver the silver they owe. And they will trigger the cash settlement clause. Every futures contract on the COMEX has fine print. And that fine print says that if physical delivery cannot be made, the exchange has the right to settle the contract in cash. This is the nightmare scenario for the paper holder. Imagine you bought a futures contract at $30. The price goes to $90. You think you are rich. You stand for delivery because you want the silver. But instead of sending you a 5,000 ounce bar of silver, the bank sends you a check for the dollar difference. They say, here's your profit. The contract is closed. Have a nice day. You might think, great, I made money. But you missed the point. You didn't want dollars. You wanted silver. By the time you get that check and you try to take those dollars to a physical dealer to buy actual metal, the price on the street will be $150. You have been cash settled out of your position at an artificial price, while the real asset has moved out of your reach. This is already starting to happen in the wholesale markets. We are hearing reports from industrial buyers that dealers are quoting unavailable or 6-week delays for volume delivery. When a wholesaler tells you 6 weeks, they are praying that they can find the metal by then. It is a soft default. But when the force majeure announcement hits the news wires, it will be a hard default. It will mark the official detachment of the two markets. We have talked about the separation of paper and physical before, but in a force majeure scenario, the separation becomes permanent. The COMEX price becomes a museum exhibit. It becomes a zombie number on a screen that nobody can actually trade. Meanwhile, the street price, the price you pay to hold the metal in your hand, goes vertical. Our analysis suggests that when the first major short declares force majeure, the street price will gap from $90 to $150 overnight. Why $150? Because that is the price where the panic buying becomes absolute. That is the price where Samsung and Tesla realize that the paper market is broken, and they start bidding directly against each other for the remaining stockpile. This is the commodities supercycle that Samuel Benner predicted. A supercycle isn't just a bull market. It is a period where commodities become the dominant form of collateral in the global economy. It is a period where he who has the gold, or in this case the silver, makes the rules. The banks are fighting to prevent this because they deal in paper. If paper becomes worthless, they become irrelevant. But they cannot stop it. The Benner cycle turns regardless of the Federal Reserve's wishes. The insolvency equation must be balanced. So, what is the final verdict for you, the individual investor? You are standing at the precipice of the greatest wealth transfer in history. But to participate in it, you must follow one simple rule. Do not accept the cash settlement. If you own physical silver, you have already won. You have exited the system. You hold the asset that the banks owe but cannot deliver. Do not sell it to them. They are shaking the tree one last time. The volatility we saw this week, the crash to $86, the rip to $92, is designed to make you let go. They want your physical metal because it is the only thing that can save them. If you sell at $90, you're bailing out Bank of America. You are bailing out Citigroup. You're giving them the life raft they need to survive the storm. Hold your position. The real price of silver is not on the screen. The screen is a fiction maintained by algorithms that are about to be turned off. The real price is determined by the unobtainium factor. How much is a missile worth if you can't build it? How much is a solar panel worth if you can't code it? Silver is not just a trade. It is the linchpin of the Industrial Revolution. And the banks have shorted the Industrial Revolution. They are betting against the future. You are investing on it. This is why the force majeure is inevitable. They have promised to deliver the future, but they sold it all in the past. When the announcement comes, and it could be next week or next month, do not panic. Do not look at the news anchors who will tell you the market is broken or frozen. Understand that the freeze is the confirmation. It means the paper game is over. It means that the price discovery mechanism is moving from New York to Shanghai. It is moving from the derivatives desk to the physical vault. We are witnessing the death of the illusion and the birth of reality. Bank of America and Citigroup are sitting on a $390 billion mistake. Do not let their mistake become your loss. Let it be your gain. The clock is ticking, the vaults are emptying, the cycle is turning. Welcome to the age of real money. Subscribes.